Indicators and oscillators are tools that help identify the prevailing trend and sentiment, and are also used to determine turning points as well as entry and exit points. Some of the most popular indicators are moving averages, SMA, WMA, EMA, Bollinger Bands. Some of the most popular oscillators are MACD and RSI. Moving averages are basic indicators for determining trends. When the price of an instrument is above the moving average, the trend is up, and when it is below, it's down. This is a very simple but very effective tool. Moving averages are used to gauge the direction of the current trend. Every type of moving average is calculated by averaging a number of past data points. Moving averages can be calculated based on closing price, opening price, and high or low prices. For identifying significant long-term support and resistance levels and overall trends, the 50-day, 100-day, and 200-day moving averages are the most common. A basic trading signal on moving averages appears when prices cross the moving average. A sell signal is indicated when the asset's price crosses under the moving average. This suggests that the market price is losing momentum and is underperforming when compared to the moving average. A buy signal is when the asset's price crosses over the moving average. This is an indication that the prices are trending upwards as it is increasing at a faster rate than the moving average. For this reason, this is typically seen as a potential opportunity to buy. Investors often place several moving averages on the same price chart. One of the moving averages will be designed the faster moving average, consisting of fewer data points, and one will be a slower moving average. The faster moving average will be more volatile than the slower moving average. Bollinger Bands are volatility bands placed above and below the moving average. The volatility is based on the standard deviation, so the wider the bands are, the higher the volatility. If an uptrend is strong, it will reach the upper band on a regular basis. Reaching the upper band shows the given asset is pushing higher and buying activity remains strong. When the price pulls back within the uptrend, if it stays above the middle band and then moves back to the upper band, it shows a lot of strength. During an uptrend, the price shouldn't break below the lower band. If it does, it indicates that the uptrend has slowed and may be reversing. If a downtrend is strong, it will reach the lower band on a regular basis. Reaching the lower band shows selling activity remains strong. When the price pulls back higher within the downtrend, if it stays below the middle band and then moves back to the lower band, again, it shows a lot of strength. During a downtrend, the price shouldn't break above the upper band. If it does, it indicates the uptrend has slowed and may be reversing. Oscillators take their name from the fact that they oscillate, in a manner similar to a sine wave, around a horizontal line called the line of balance. This refers to your price points and zero momentum, which is the point at which the momentum does not rise or fall. Determines when the price is susceptible to correction, when the market is exhausted in the prevailing trend. Gives a signal to sell in the overbought zone and a signal to buy in the oversold zone. Shows divergence between oscillators and price, which is helpful in taking trade decisions. The MACD indicator was developed by Gerald Appel. He shows the difference of the two exponential averages moving with 9-period exponential average of the difference as a signal line. Currently, a typical MACD indicator is defined as 12, 26, 9, where the average 12 and 26-day-old calculates the difference and 9-day average is a signal line. The result is a smooth oscillator that can give signals to the transaction, the intersection of the zero line, divergences, and the intersection of the input signal in overbought and oversold zone. Let's move to trading signals, which are generated by MACD. The MACD buy signal is generated when the MACD blue line crosses above the MACD signal line, the red line. Similarly, when the MACD crosses below the MACD signal line, a sell signal is generated. We could also place trades based on MACD when the blue line crosses the zero line. Then the buy signal is generated when blue line crosses above the zero line and sell signal when it crosses below. The MACD moving average crossover is one of many ways to interpret the MACD technical indicator. Using the MACD histogram and MACD divergence warnings are two other important methods of using the MACD. The RSI is a technical momentum indicator that compares the magnitude of recent gains to recent losses for determining when the underlying asset is overbought or oversold. The RSI is probably the most common oscillator and is typically used for 14-day periods. RSI value falling within the 0 to 30 region is considered oversold. Traders assume that an oversold currency pair is an indication that the falling market trend is likely to reverse, i.e. a bullish signal, and is treated as a buy opportunity. On the other hand, an RSI value falling into the 70 to 100 region of the scale is regarded as being overbought. This signal suggests that the resistance level for the given asset is near or has been reached and the rate is likely to fall. Traders would interpret this as a sell, i.e. a bearish signal opportunity. Remember that you enhance your trading odds by using trading signals only with the direction of the main trend.